Good afternoon, everyone. Thank you so much for joining for another one of Quest Trust Company's Self-Directed IRA Saturday. We do have a really great topic for you today, financial advocacy in an inflation and recession economy. This is going to be presented by David Phelps. We have had him on our platform before. He is a wealth of knowledge. We are going to be very excited to get through this with you today. As always, please utilize the chat box. This will be a recorded presentation, but we are happy to answer the questions we can, and we'll leave some contact information for you all at the end of today's presentation. So again, thanks so much for joining us. We do want to first start these presentations by giving you a little background about Quest Trust Company for those of you who may be newer to our platform. So we are a premier self-directed IRA company. We are the largest self-directed custodian in Texas. We have 3 offices in Houston, Austin, and Dallas. We do hold all alternative assets on this end, so we are strictly a private custodian, meaning that you typically cannot get into the public market whenever you are self-directing your IRA through Quest Trust Company. Now, alternative assets are really an array of investments that you're able to invest into. This includes things like real estate, promissory notes, private entities, cryptocurrency, really anything, again, that's not publicly traded. Now, across our 3 offices, we do host free education. So this includes both networking and educational events for you to go in either live and in person and network with those individuals, or you can watch through the same platform you're watching off of today. These classes for us are hosted every Tuesday and every Saturday virtually, and then across our offices the first, second, and third Tuesday of every month. So if you have any questions about that, please check out our website. We have an array of events that you can get involved in to both expand your network and your knowledge in alternative assets. Now, on the Quest side, we do pride ourselves on a 24 to 48 hour processing time. This allows you the greatest control over your retirement assets. We have fast and friendly, world famous customer service on this end. So if you ever have any questions, any concerns, reach out to us. We have an amazing team here who are willing to help you. Now, across our 3 offices, we currently employ about 100 individuals at this time. About a third of these individuals are certified IRA service professionals. This means they have sat through a test to go over some of the topics that they talk to our clients on the phone about every single day. So these individuals are very knowledgeable in this space, and we can absolutely help you as you work to get your investments on track in the future. Along with that, we currently have about $400 million sitting in undirected cash. Now, this undirected cash is an opportunity on both ends, whether you are looking for an investment or you yourself are looking to raise capital. These individuals are people who have moved the money over and they're ready to self-direct, but they're just really waiting on that opportunity. So please get in touch with us to learn how you can tap into those trillions of dollars that are currently sitting in IRAs today. Now, just to give you a brief overview of what self-directed IRAs are, these again are for strictly alternative assets when you go through Quest, and they offer you the benefit of things like being able to diversify outside of the current market. You do, of course, get that same tax savings that you do whenever you're investing in an IRA anyways versus personally. Things like being able to socially invest, putting money into your local economy. There's some of the alternative assets you may be investing in your self-directed IRA. And finally, one of my favorite ones to talk about, being able to invest in what you know best. If you are already investing into these alternative assets outside of your IRA, moving that in can offer you a good amount of trust and value whenever you are more familiar and comfortable with the assets you're holding there. Now, there's a short list on all 3 of the most common categories of assets that we see in a self-directed IRA. But what we always want you to be aware of is that self-directed is truly just a marketing term. All it lets you know is that your custodian is going to allow you to invest into the broadest possible spectrum of assets. And that is where we come into play on this end. Now, like I said, we do host classes on the online side. These are going to be every Tuesday, every Saturday at noon Central Time. You can tune into our YouTube page, go to our website, questtrustcompany.com, and register for the classes, and we'll send you a link right before it starts. We also have our networking events that will take place in person in Houston, Austin, and Dallas. These are in the evening, so 6:30 p.m. Central Time. It's about an hour of networking and education for you to really get in front of those audience. Now, those also offer deal pitching. So if you are tuning in from online, you may not be able to deal pitch. However, you can still listen to the individuals that have the opportunities that you may want to invest into. One of my favorite events as well is the National Networking Happy Hour. Now, this is a virtual event that takes place every fourth Wednesday at 6:30 p.m. Central. It is strictly virtual. It is a Zoom call, essentially, where you'll be able to network with individuals who either have the capital or the opportunity for you to invest. This is an extremely valuable event. I would highly recommend you get involved with this, even if it is just to sit and listen for the first time around until you're ready to jump in and let them know what it is that you're looking for. Expand your network and your education through this event. It is very, very valuable. And last but not least, every single one of the events that we put on a regular basis are going to be recorded and posted to our YouTube page, even this one. So if you're just tuning in and you want to know some more of the information that I'm talking about right now, you can simply log on to our YouTube page and rewatch any of the educational webinars that we put on a regular basis. I want to talk, of course, about this upcoming event that we have December 9th and 10th of this year, so upcoming very shortly. This is QuestCon Live. So we will have industry experts who will be not only forecasting the upcoming market, but talking about where the 2022 market and alternatives went based off what their predictions were this time last year. So there's going to be some really great information. Get the knowledge and the tools that you need to start investing into alternatives. Or if you're already investing into alternatives and you're looking for a new opportunity, see where these individuals think the market is headed. Very valuable information for you here. And for those individuals who are just getting started, this is truly a great event for you to gather what you need to feel comfortable moving forward. You can find all of this information on our website, questtrustcompany.com. We are going to be selling tickets to that, so feel free to log on. If you have any questions at all, please do reach out to us. We do have a promotion as well. We want to talk about this one specifically. Our author is Quincy Long, the founder of Quest Trust Company. He goes into great detail about self-directed IRAs. I've read this book myself. There is a wealth of knowledge that is contained within the pages of this book. And for this month only, if you open an account with us, we are going to give you that book for free. Outside of that, if you're not ready to open that account just yet, please check out this book if you're interested in self-directed IRA investing. There's truly so much information that surrounds alternatives and specifically self-directing these alternatives. And so you'll get to hear that from an expert in the industry, someone who has been investing into this for 20 plus years and is an expert when it comes to self-directed IRAs. So certainly check that out if you have not already. Now, any questions about anything contained within this presentation today, any questions about our events, about self-directed IRAs in general, please give us a call, chat with us on the website. We do have a certified IRA specialist monitoring that chat during normal business hours, so you should be able to get in touch with us very easily. You can also send us an email. That IRA specialist at questtrust.com is a general email. We will have one of our certified specialists respond to you and potentially set up a time to talk about your specific situation. So do let us know. If anything comes up, we would be very, very happy to help you. Now, with all of this being said, we are going to jump into today's topic. Again, that is financial advocacy in an inflation and recession economy. Now, this is going to be presented by David Phelps. We do love all of his presentations when they come through our platform. Again, a wealth of knowledge and information for you. So we will go ahead and with that, get started with the actual presentation.
Hi, I'm Dr. David Phelps, the founder and CEO of the Freedom Founders Mastermind community. I help high-income professionals create a Plan B wealth and cash flow model outside of their conventional retirement accounts on Wall Street. Why? Because the conventional model just doesn't work. It's a gamble at best and creates a lot of uncertainty for people in determining when they can exit, when they can actually retire out from whatever their active income has been. Real estate, in my opinion, my experience, is really the best vehicle to create long-term wealth, cash flow, and that financial independence. It's a model that takes some work, it takes some education, takes some connection, takes some experience, but that's why you're here. Hope you're having a great day today. I love participating with Quest. The clients at Quest, the staff, the leadership at Quest are top shelf. I've been a client myself with my retirement accounts for over 15 years, even before Quest became Quest. I've known Quincy long, that long, and have a great deal of respect for Quincy and the culture that he's built over the years at Quest and helping so many people like me, like you, create a retirement vehicle, cash flow model that really makes a lot of sense. I'm here today to discuss really the current market cycle and some of the best positioning that through my years of experience, I think can set you up in whatever way that you are participating in the real estate market and with retirement accounts. That's what this is all about. It's all about cash flow. In the end, real estate or your assets, your investments should be about cash flow. It doesn't mean you have to be focused on cash flow today or next year or the next year. You may have enough active income in your business or your current profession where you're interested in growth. And growth is great, but learning how to do both. Some current cash flow, some growth to hedge against inflation, have capital gain opportunities is something that you can have a hybrid approach to it. So where are we in the market cycle? How do we position ourselves against the volatility? What are some of the best asset allocations you might be able to make or help others make that are working with you? That's some of what we'll talk about today. Navigating the folly of the financial markets. We'll get into that a little bit because that's something we always have to keep in mind. There's always business market cycles. They typically happen every 6 to 8 years. This last one, coming out of the 2008 downturn, the Great Financial Recession, has been pushed out much longer. Artificially subsidized. And I think the longer we have a market cycle that's gone longer than the average, the more chance there is for more volatility on the other side. Again, if you're prepared, you're positioned, you've got connections, relationships, you can make a lot of headway in those markets. Unfortunately, the vast majority of people, not you, that's why you're here, but the vast majority of people are not prepared. They don't understand market cycles, kind of head in the sand. They're busy, too busy to really gain the financial acumen that they need to be able to do what we have to do today, to get beyond what the Congress and the Federal Reserve through their monetary and fiscal policies cause in the disruption of the marketplace. What I love about real estate, what you should love about real estate is it's a very inefficient market. It's not like Wall Street where high-speed computers and algorithms are doing trading that you as a retail individual cannot access. You can't beat the financial markets. You can buy it, whatever it is, you can buy into it, but you're not going to get a deal there. You can pretend you can make trades and use arbitrage. I think it's just nearly impossible. Real estate, totally opposite. You do have a place there. Real estate is inefficient. The inside information, connections to people, access points that either you have or you create through your relationships is where we have the advantage. But it does take time and effort. I like that. I like the fact that we have to do a little bit of work to make this happen because the vast majority of people won't do what we do. And that gives us a competitive advantage. It's all worth it in the end, in my opinion. So a little bit about me. I actually got started in my real estate venture almost 43 years ago. Yeah, I'm that old. But I don't feel that old, but I started in 1980. Yes, I was going to school. I was going down the pathway that I thought was going to be all about financial freedom, which was to go into professions. I went through college. I got into dental school. But while I was still in college, I started reading books about being an investor. Why? Well, I always am curious about finances and making money and being independent. Even though I had no real independence back then, I still wanted to see how quickly I could get there. And between Wall Street, mutual funds, stocks, bonds, and real estate on the other side, it just seemed to me that real estate made a lot more sense. I had more control, and I love control to some extent. I don't want to control everything, and that's the kind of pathway we'll talk about a little bit today. But as I read books, I decided, I'm going to be in school, dental school for 4 years. I could either pay rent or I could actually invest in gain equity in an asset. Well, how could I do that when I don't have any credit? I've got more debt than I have assets. I have a negative net worth. Well, joint venture. It's kind of what we do today, right? Joint venture. You bring to the table what you bring. That might be connection, time, skill set, experience, willing to go out there and do the work actually on the street. Great place to start when you're younger or learning the model. I needed access to capital. Well, fortunately, I had a father who believed in me and brought the credit and the hard money down payment to finance the first property that I say we bought together. That was 1980. Oh, by the way, interest rates at 1980, the federal funds rate was 20%. Yeah, 20%. We had inflation running back then at 14, 15%. That's in 1980. Actually, many years of that, and I'll get into that in a minute. So I bought my first property, invested in it at a time that we haven't seen in 40 years. High inflation, high interest rates. And people today are bemoaning the fact that, oh my gosh, we have relatively high inflation and we have higher interest rates. How's that going to work out? Well, we'll talk about that. I took my capital gain profit from that first property, which was about $25,000, and parlayed that into multiple properties. Yes, I had to use a lot of leverage. I used a lot of creative financing, subject to seller financing terms, to build a portfolio, boots on the ground, that allowed me to get free of my dental practice at a relatively young age. Now, why? Was I unhappy with dentistry? No, has been a great profession, but I have a daughter who unfortunately went through a lot of health crises at an early age, leukemia, epileptic seizures, and then at age 12, she had to undergo a liver transplant. She was in end-stage liver failure. We'll go into the details of that. Good news is she survived all that. She's healthy today, 30 years old, amazingly. But I decided at that time, when she was going through life-saving treatments and an organ transplant, that I had to make an assessment as to where I was in my life path and what was most important. And my time, having more flexible time, was more important than making more money. Now, fortunately, I had the real estate that, not through any home runs, but just the compound effect of investing in real estate over those many years, gave me enough passive cash flow to exit my practice, sell it, put more of that equity back into real estate, and set me free, at least for a period of time. I just needed a period of time to be with my daughter because I didn't know if I would have more time with her. I think you all understand that. I didn't know if I'd go back to dentistry or not. I always could. I could still today, but I never did. Why? Because that freedom allowed me to actually go to my next in life. Real estate's always been a love, probably more of a love than dentistry, honestly. I love the art of the deal. I love finance. It's probably a place I should have been, but who knows? The world and life has a way of doing things in a way that we don't always understand. But learning what I learned and helping my colleagues in the professions, understanding where they are in trading time for dollars on a hamster wheel, high income, but where's the certainty? Where's the ability to exit? You don't have that in Wall Street. It's never enough. You don't know how much is enough. Real estate, you can do that. So Freedom Founders is a community that I started a little over a decade ago, just organically. And today we help a lot of professionals in accessing real estate as more passive investors. I don't teach them active investing because that's not where they are, what they want to do. But I will give some context to both sides today. I'm going to talk about the market a little bit, and I'll flip to my slides in just a moment. This is a book that, what's actually behind me on the shelf back there, but this book, Inflation, the Silent Retirement Killer, is a book that I wrote a year ago, published it in April of this year, so it's very, very current. If you need some help in looking at the current markets, because many of you, have not gone through markets like this, again, my age shows I grew up in the 70s, started investing in the 80s, and started adulthood in a very different time than we had just a few years ago. We're kind of back to that era. Are we going to have more stagflation like we had in the 60s and 70s, where we have a high cost of living, but a very anemic economic base? I think that's where we're headed right now. So you have to learn how to navigate it. It's going to be different than we've seen in the last 2 years with all the COVID stimulus money that's come out. It's going to be different than we've seen in the last 10 years coming out of the 2008 Great Financial Recession, where it seems like anything you invested in, whether it was Wall Street or real estate, it just went up. Well, those were tailwinds that we could, and many people did take advantage of, but it doesn't last forever. Many people think that they've done, well, many people have done very well, I should say, and good, that's good. In your businesses, in your investing, wherever that's been, but we have to take homage to the fact that those great returns are partially based on our efforts and doing something, so give yourself credit for that, but a lot of that is because of the market. So understand we're going through a big change. It's probably time for me to flip to my slide deck. I've got a few slides here, so I don't run out of time. So let me share my screen And let's jump into the slides here. Give me a second. And let's see if I can make all of that happen. Good, good. And one more click and we should be there. All right, I think we're loading right now. Here we go. All right, so my topic today is the cheese has moved, financial advocacy in an inflation and recession economy with Quest Trust Company. Let's jump into the first slide. The era of cheap money is over. As I mentioned, I started in 1980 when we had very high interest rates and high inflation. We've had it since then, since 1980, we've had a down cycle of decreasing inflation. In fact, inflation went down pretty heavily after 1982 because of the high interest rates. What the Fed is simply trying to do again today is bring inflation down because inflation is not good for the masses. People don't have enough money to make ends meet. So the government tries to fix the problem they created in the first place by raising interest rates. The problem is raising interest rates also has a negative effect on the economy. And I think we're probably due for a recession of some degree in the next quarters, into next year. I think it's pretty highly likely. How deep in a recession? Anybody's guess, but I think that's going to be a trigger point. We've had easy money, cheap money, easy credit. Liquidity has been everywhere, which causes asset bubbles, financial bubbles, real estate bubbles. At the same time, though, we have consumer price inflation. So we've had bubbles and consumer price inflation. We're now going through a correction in the market, which is way overdue, in my opinion, on the asset side. Asset prices are coming down. We have asset deflation after we've had years of inflation. But at the same time, consumer price inflation. Got it? Inflation on the consumer spending price point, deflation on assets like financial assets, stock market, 401ks, real estate to some degree, although with real estate we can navigate that much better. That's the benefit. We've had a lot of exuberance in the recent marketplace, as I mentioned, in the last couple of years. People that thought that they were a genius and everything they touched turned to gold. Beware, beware, beware. Don't, if that's been you, good for you, but don't take that as something that you can continue. You're going to have to be very, very discerning about the market going forward. Be careful of recency bias, which means just thinking that what's happened the last few years, you can continue to make that happen. It's going to be a different marketplace. It is a different marketplace right now. All right, so let's move on. Generational wealth, the great wealth transfer. This happens every time we go through a major business cycle. The last one, again, was back in 2008. But generally, every 6 to 8 years, we have a business cycle, a correction because of the manipulation, the interference of the government, the Federal Reserve, the central banks in the marketplace. That's just the way it is. Is it right? Is it fair? We have no choice about that. We have to learn to deal with it. But if you learn to deal with it and position correctly, you can actually make a lot of money, make a lot of headway during these times. But you have to be in the right place, right time, ready to go. And that's the opportunity I see ahead of us. Money's never lost. People say, well, the stock markets has lost trillions of dollars, which it has over the last 6, 7, 8, 9 months. Definitely has lost a lot. Where does that money go? It didn't just evaporate. It's going to other people's hands who are there buying the assets. Whether it's stocks, if you like stocks, then you can buy stocks, when you think it's the right time. Real estate, a lot more opportunity, in my opinion, because real estate has a lag effect. Real estate, because it's an inefficient market, takes more time for the changes in the market to appear in real estate, meaning how quickly we see some assets in real estate drop, and then knowing where's the strike point. When should I enter back in the market? In the interim, well, how do I continue to invest? We'll talk about that. Realize that assets, in all regards, go on sale during market corrections. Asset allocation. A lot of considerations here. I put it on the screen here, what's called the capital stack. You can look it up, spend more time on it, but understand the capital stack is a financing structure that's built into every financial model. There's two components to it, essentially. The red or rose-colored, that's the debt stack. That's where typically a business, a company, an investment opportunity, real estate acquisition starts with some kind of financing. That's the way you acquire assets or build businesses, is you utilize debt, other people's money. The equity side is what most of us think about in terms of assets. We want to own the asset. We want to own stocks, if we like stocks, or you want to own the equity in tangible assets like real estate, whether that's your home. If you consider your home an asset, some people would say it's a liability, but let's say rental properties, or you may be a limited partner in syndications that own the equity in multifamily or self-storage facilities. That equity ownership is typically what we like in real estate because it has the growth component, hedge to inflation, appreciation, value add, tax benefits. That's a great place to be. But during times of market changes, market cycle, it can be more prudent to hedge on the side of being on the debt side. Now, not debt as the borrower, but maybe debt as the lender. That's where retirement accounts can be a great game changer. You have money in your retirement accounts and say, well, where should I invest? Well, investing in debt, being a lender, being the bank is a great place to be. And you can also access money from people's retirement accounts so that they can be the lender for you and use the private capital markets instead of relying on the institutional bank markets, particularly when we're going through a correction. At some point, the capital markets, the credit markets are going to tighten up. Liquidity that we've seen a lot of in the recent years is going to tighten up, and that's going to mean that the typical financing opportunities for people who use it a lot is going to dry up. Many of those people are over leveraged. They're going to have to sell their assets. That's where assets go on sale. If you have access to your own capital or other people's capital, again, retirement accounts are a great place. That's why mixing it up and networking at Quest events, particularly the live events where you get to go and meet people. See, everybody's going a different way. Some people want to build their estate and they're willing to do the work and they want to own and operate the equity. And other people, kind of like where I am today, I'd rather participate with them, but I can do that by, in many cases, lending the money. Or I could be an equity limited partner. It just depends on where you are and where you are in the market cycle. I would say, take what the market gives you. Don't try to make the market fit your model, but be flexible, be able to pivot, understand the market dynamics change. And when you can be nimble and roll with the markets and reposition your positioning as to what you do and how you solve problems, that's the opportunity. Be flexible in how you participate in the market. That's the key. Also, I'll say this, many people say cash is trash. I say not always the case. Cash can be a real asset to a point. Now, I truly believe that we're going to see inflation stay moderately high for quite some time. And during times of inflation, cash is eventually going to be devalued. We know that. Over periods of time, yes, you can't stay all in cash. But when we're going through a market cycle like we are right now, having cash, or better yet, even access to cash, people who have it, is what's going to give you opportunities to jump back in. If you have a lot of capital, keeping some money in cash right now is not a bad idea. If you don't have a lot of capital, you have more time than money, then it's your chance to get out there and make it happen. Solve problems, be out there mixing it up and be the connector. Orchestrate, bring things together, use other people's money. If you're the operator, learn how to do that, network, get the education, get the experience to do that. But liquidity is going to be, I think, a real benefit for people in business and in investments, because you've just got to get through this gap. You've got to get through this zone of time that we're going through, the correction that's going to happen over the next number of quarters. I think probably well into 2024, we're going to see this, see deflation of assets to some degree. And again, real estate is very local, so I can't say overall that the real estate market's going to drop by so much. In some markets, it won't drop a whole lot. In other markets, it will drop a lot. So understand which markets you're in. These are tactical considerations that other people during this weekend will providing that information. I'm trying to give you a big picture. So take some of my points, figure out where you are, and then dive into the other presentations or go to the Quest website. Lots of information there. You can determine, okay, here's information on how I can be a lender or how I can access money to fund my deals from retirement accounts. It's all there. Just dive into it. I don't have time to give you all the tactical. I'm going to be big picture for the most part today. Let's go on. Protecting downside risk. Very, very important during times of market volatility and disruption like we're having right now. I mentioned earlier, income versus growth. Income, taking distributions or what I call first money out versus back-end participations. Back-end participations, which are great, that's the growth component. When you have equity ownership or equity interests, you are getting some of both. You should be getting some kind of returns, the dividend, rent, or interest returns. And then there can also be that back-end inflation hedge, value add, appreciation component. So determining where you want to be in the current market cycle. Personally, right now, I'm not betting a lot or putting a lot of my interest in the back-end participations. Oh, having some there, absolutely. Or the right deal that I know that either I'm on the forefront of it, or somebody else is driving it as an operator who I know, like, trust, and I know they're getting a good deal, okay, I'll jump in and take a bigger piece of that back in. But for the most part, I'm kind of interested in my investments today being more where I'm seeing the actual cash flow distributions. Not that I need the cash flow, but I think it's a safer position to be in general. In general, these are general comments I'm making. There's always exceptions to everything, and that depends upon how dialed in you are to your investment opportunities, whether you're on the forefront of developing the opportunities because you're on the ground, or as a more passive investor, you have access points and relationships. But determining what you think makes sense for you, I think being on the capital stack side of the lender or getting first money out makes more sense than putting a lot of emphasis on the growth opportunities we've had in the last several years. Now, again, we'll cycle through this. End of 2023, 2024, perhaps will be a great time to jump back in and start buying assets on sale or investing on assets in sale, either equities or debt or a combination thereof, and ride the market back up like we did coming out of the 2008 downturn. This will be, I think, a similar cycle, although we may not see again, just saying we may not see again the high growth that we had in this last cycle, because I think the Federal Reserve is out of ammunition and can't really stimulate the economy like we have in the past. Well, we have so much national debt. Can't go into that right now, but the national debt is kind of a linchpin to why the Federal Reserve has not as much ammunition to do what they've done in the past, manipulating the markets, always bringing the assets back again. I think they're going to have to let some of that go. Buy when there's blood in the streets. Again, that's a common moniker that we've all learned, I think, over the years, is that when people are greedy, then you should be fearful, which is what we've seen in the last few years. People are still greedy today, by the way, unfortunately, and don't see what's coming. But when people become fearful and nobody wants to buy anything, that's a great time to be investing in whatever asset class that you feel like is right for you. Patience. Having patience can be a virtue. Don't have that FOMO that I got it out there doing just because everybody else is talking about crushing it and how they're buying all these deals. Again, I'm not saying you shouldn't or can't be finding good deals today, but how good are they really? Have considerations been made for the onslaught of what's going to happen in the months and quarters to come? I think we're going to see a lot more volatility in the marketplace. Just beware of that. Hedging against the asset deflation correction. Again, on the same thing. We're going to see and seeing right now assets, financial assets, real estate assets, business assets, they're going to start coming down. Again, it's an inefficient marketplace on the tangible side, which is great. Not every asset responds the same way. Some assets will have a smaller reduction. Other assets in certain areas will see a bigger dip. You've just got to determine where's your best positioning. As I said earlier, focus on the cash flow. I want to know, what is the cash flow production from this asset? If it's strong enough and I haven't over leveraged, I've got enough cash flow margin, then I don't care if the asset value goes down because I'm not a net seller. I'm in for the long game. You've got to get through the stretch of the downturn of the economic cycle to make that work. If you're over leveraged, you have bought incorrectly, you have not provided enough margin for rents to slow down, maybe rents even come down a little bit. It's very, very possible that could happen. You've got to have enough margin or be investing with somebody who's provided enough margin in the investment asset to allow for that. Growth and appreciation for me right now, that's icing on the cake. We'll find a time again where that ride will be significant. What's more, you've got to have a strong balance sheet. What I mean by that is again, cash or liquidity. Having strong assets that you can access, that provides you the liquidity, the margin, the cash that you need to support some of your business interests or your other investments that need a little support during this time. Very important to have that. Don't be strung out where you're razor thin, especially right now. Bulk up. Develop some relationships. Check your debt. Long-term debt, fixed rate debt, no variable debt right now. Very, very dangerous. And then finally, know your market, know your niche. Real estate is a niche asset investment. Markets, asset classes, know that market or know someone who does, because that's your key. That's what no one else has access to that won't do the work and doesn't come to educational events like this or networking like Quest provides. Positioning for new opportunities. Okay, this is the fun part. This is where I'm waiting for different opportunities to kind of reallocate my capital, keeping a lot in more liquid investments right now on the debt lender side, but that money is more fungible and I can move that relatively easily into equities again when that comes. But right now I want liquidity or access to cash through my relationships. just having it ready to go. Access points, your network. Your network is your net worth. I say that all the time because I truly believe that. If I had to give up anything at all in my life, I'd give up my money, my assets, but I'd never give up my relationships. Why? Because relationships are how you can rebuild if you ever get into hardships. Relationships are actually what can get you out of hot water if you built strong relationships based on integrity and your track record that you do what you say you're going to do. I've got access to more capital than I could ever use in my life, not through the banks, but through people I know because I built a reputation over the years. You can, or maybe you've done the same thing. And if you've done, that's your best insurance policy over anything else you've got. Take that one to the bank. Relationships, do what you say you're going to do, high integrity. Your reputation is everything. That's what's going to save the day if you ever get into trouble or provides you the opportunities that you're positioned to take upon. Collaboration versus competition. It's a wide open universe. Too many people, I think, in business, in investing, they feel like it's competitive, and I don't want to share. I don't want to talk about what I'm doing. Wrong approach. You've got to have an abundance mentality in life and in business investing because, again, everybody's going different places. Sharing information, collaborating, it's the best way to figure out how you could put together, orchestrate deal-solving opportunities that other people can't do. See, there's always the retail market, the conventional marketplace, right? And that retail market works great when the market is in a bull run, like we've had over the last 8-10 years. But when the market cycles down the other way, the retail conventional market, it just about dies, and it will die. It will come to a slumbering stop. But under that level of retail is what I call kind of the underground. That's private capital markets. That's what we're talking about here today. Nothing wrong with using institutional money when it's the right time to use it, but you can make headwinds go away and use tailwinds when you've got access to private capital. You can solve problems. You can put deals together that nobody else can put together because of the network and the private capital opportunities. If you've never been through this before, it's really an exciting time. You can tell I'm excited, right? I'm not afraid of this. I've been through it a few times. I've got a little gray hair to show it. I got the scar tissue on my back, but that's, I'm the kind of people, and there's other people that are presenting this weekend as well. That's who you want to learn from. People who have been through the market cycles can actually share not just theory, but actually real experience, real wisdom. Know your strike points. What I mean by that is know where and when is the right time for you to invest your capital or put together certain deals in certain markets, and whether it's equity or debt. Again, I can't give you the technical of that right now, but understand that there's right times to invest in certain assets, certain markets, because either you have the wisdom and experience or you know somebody who does. Again, you don't have to know it all, just know somebody who does. All right, here's my last big point. Creative financing is back big time. Learning to structure deals for profit and cash flow. This is the market I grew up in. This is the 1980s when interest rates were really, really high. We're going through a market correction. And in that 1980s is where I leveraged all the properties I bought. Seller financing, getting terms from sellers to finance my deals, taking properties subject to existing financing, using some private capital. I did not go to the banks. I did not use the banks, and I built up a portfolio of several $1 million and 35 some houses and passive cash flow that over time, as I paid the loans off, created me my exit plan when I had to leave or wanted to leave my practice because of my daughter, Jenna. That was the huge opportunity. Creativity is the key. Most people are used to just using cash and getting discounts from people. That game is going to be minimized. Using terms to make the deals work for you is the key, and it's a prime opportunity we're heading into right now. This is the time to learn, if you haven't learned before, from people who can teach you about the creative financing structures. Communication skills, sales skills, negotiation skills, key elements. Right now, it's your time. Terms versus price. I can make deals that other people can't make because everybody is focused on price. I can make it work on terms. Facilitating transactions that no one else can do. If you could be that person or know someone who does that, you're in for a great market ride. It's been fun to be with you here today. Have a great day. Keep learning, keep networking, keep sharing, keep collaborating. That's the key to everything in life. It's been my pleasure to be here. Again, I'm David Phelps, freedomfounders.com. Have a great day.
We want to thank Dr. Phelps for being with us today and presenting his wealth of knowledge in the industry. As you heard, he is been in this industry for quite a while, so he's very well informed on how the market works, speaks very good into things like doing your due diligence, and specifically something that I think is very heavily involved with self-directed IRAs, which is creative financing. So really, really love to hear that this afternoon he has presented so much information for us all. We will leave his contact information for you in the chat box as well if you'd like to reach out to him directly. In the meantime, feel free to put any of your questions in the chat box for us now. We always like to open up the floor to any comments that you may have. I see that we've gotten some wonderful comments about the mindset that David Phelps teaches, which truly we love to have and see on our platform. So just give you a moment to ask any questions you may have, and I'm going to go ahead and pop his contact information right there on the screen for you as well. That way you can reach out to him and his group directly with any of the questions you may have specific to that education. Okay. Yeah. Not seeing any questions come through just yet. So we want to thank everyone for joining us today. As far as how he was able to, apologies, see a question come up, how he was able to 5 houses, I think that really speaks to his creative financing background. Like he says, there's not going through your traditional bank. He has quite a few different ways that he's able to do this, including seller financing and things of that nature. I would recommend reaching out to him directly to really get into the nitty-gritty details of how he is able to accumulate the portfolio that he has currently. I think that he will be able to share a little bit more of the ins and outs of that. But as he said, creative financing was really the backbone of where he is at today. So certainly contact him. He will be able to go ahead and get into a little bit more detail with you, potentially talk to you about your situation as well. And if there are no more questions, we will be here at same time next Tuesday and next Saturday with some more information on alternatives, as well as self-directed IRAs. Please join us. Look on our website on questtrustcompany.com under our events section. You'll be able to sign up and register for these upcoming events and also see what we have on the calendar for the upcoming months. I do have another comment here. So talking about the current market is, since it is taking a dive, should we be on the sidelines till it bottoms out? Truly a question I would speak to an advisor about. I would say they're going to be able to look at your specific situation and exactly what it is you're looking to invest into. We are not able on this end for sure to provide any type of investment, tax, legal advice. So certainly reach out to a qualified financial professional that can take a deep dive into what your situation looks like and see what your best moves are from here. And we are ending just a little bit early this afternoon. But again, thanks so much for joining us. We hope that you enjoy the rest of your Saturday.